Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Question here from John, wouldn't you want to buy a straddle or strangle if you're at the mid-range of support and resistance? Yeah, I mean, absolutely. That's certainly a good way to look at it. And I maybe what I can do is just go back to one of the charts here, and let's. I'll go back to the Canadian chart here, if you just bear with me for 2 seconds. And what you'll see is that we've been really looking at the from a technical perspective. You guys can see here, if I can grab one of these drawing tools, you guys can see here that that we've had a essentially the 107-108 range has been an important resistance level on the CDD for quite some time. So if we're looking at a period of relatively low implied volatility, suggesting that the options are priced fairly reasonable, and we're looking at, in this case, the pair value trading at a level of resistance, the idea is that we're either going to see, from a technical perspective, we're either going to see a break above or beyond this resistance level, likely facilitating in an accelerated rally to a higher target, or we're going to see a rejection here, resulting in a test which may come back down to test some of these lower levels. So in this case, you know, again, the CDD from a technical perspective is trading at a resistance level. A break above is likely going to facilitate a move higher. A rejection here is likely going to result in a move lower. Consequently, a straddle or a strangle strategy is something that one might consider looking at. The other idea, and I can use that same sort of outlook if we fast forward here and take a look at the chart on the AUX, is more or less the same sort of observation here, is that this 115, 116 zone right in here is also has been sort of providing a little bit of a resistance level over a certain period of time. Again, with option premiums being relatively low, considering the 52-week high, one might look at this here being sort of that decision-making point. Could go higher, could go lower, not sure. Let's trade a call and a put and see what happens. If you're somebody that is looking at it from trading a directional bias, you're going to want to see that definitive break above or a definitive rejection at that resistance level. But quite certainly, John, absolutely right. These types of strategies, you want to more or less see the underlying trading at a support or resistance level where the market is sort of at the crossroads as far as making a directional sort of decision. So just to fast forward once again through the this particular strategy, you can see that our risk-reward profile reflects that the importance of recognizing that your profit and loss range, or the range at which you can assume a loss, is widened because your strike prices are that much lower in the case of the puts and that much higher in the case of the calls than the actual where the underlying security is trading at presently. So these option contracts, because they're further out of the money, tend to be less expensive, but recognize you need a greater move in the underlying security to realize a profit. The other thing, of course, is that implied volatility, as the market begins to, if we think back to that distribution curve, when the stock is underlying security is here, these option contracts are further outside of that distribution curve, but when implied volatility increases, you'll find that these strike prices will increase in value based on that widening distribution curve, or that increase in implied volatility. So when we're looking at it, again, identifying the sort of how we want to trade these periods of low volatility, recognize again that we can profit in two ways by being both long a strangle or a straddle when the market is really hasn't been moving, has been trading more or less within a range, and where we anticipate a move either to the upside. So when we anticipate a move at some point taking place in the near future, we buy a call and we buy a put, and we look to capitalize on a move in either direction. Now, we can also profit not only from a directional trend as that trend is underway, but also that expansion in volatility from a period of low implied volatility to a period of high implied volatility. If we're looking at a current scenario where volatility is high, and we feel that maybe options are priced a little too dear for being an options buyer straight up, we can actually use what's known as a debit spread to offset some of the costs. So when call and put options are expensive from an implied volatility perspective, it's attractive to be an options writer. In the sense that we're looking at the ability to write out of the money option contracts and collect a higher premium. So if we kind of take it back, when implied volatility is low, in order for an option writer, in order to generate a significant premium, we have to adjust for that low implied volatility, and we have to choose an option contract that is closer to that to within that standard deviation. But during periods of high volatility, as an option writer, we can go further outside of that standard first standard deviation and collect an attractive premium. But as an option buyer, this means that premiums become a little bit more expensive, and there should be a space here, guys, before or after expensive. But what this does is when we pay a higher premium for the option contract, we're in fact taking on a greater risk based on what the possible reward could be. So when options are cheap, we're paying a low premium for a higher reward opportunity. But when option premiums are high, we're buying in a period of high volatility, and we run the risk of volatility contracting. And even if the stock does nothing or doesn't even move down, we can still lose money because of that contracting of volatility. But what we can do is we can offset that cost by creating a debit spread. Now, what the debit spread does is it puts us in a scenario where even though we're long the option contract, we're in fact using that implied volatility to our favor by being a seller also at the same time. So let's say we had a bullish outlook on a particular security. What we could do is buy one call option and then sell the higher strike call option to bring in some premium to help offset that expensive call option that we've just purchased. Now, of course, we're going to do this utilizing the same pair value, and we're going to do this using the same expiration date. So if we take a look at EUI, the EUI, for example, which is the U.S. dollar versus the euro, and let's say that we felt that perhaps there was the possibility that the U.S. dollar was going to continue its rally against the euro. Obviously, from a technical perspective, that move is fairly well extended right now. But let's say that we felt that it was going to move higher, and we wanted to participate. Well, with the EUI trading at 73, we could buy one June 73 call and pay out $2.60. But at the same time, we could look at perhaps an overhead target of 77, and we could sell that 77 strike and collect $1.05. In this case, what we've done is we've lowered the cost basis of this particular strategy from what initially would be $2.60 all the way down to $1.55.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.